Welcome back. We're jumping right into an analysis of Paranovus Entertainment, or PAVS. And the core of this piece is a paradox you just can't ignore.
A huge one.
An 18,000% revenue surge year over year. But at the same time, the stock price has collapsed by 96%. It's trading at just 4 cents.
And the report nails that core dilemma right away. The numbers are all there. 12.4 million in revenue for the first half of 2025, even a tiny net income. But what we need to do is make sure the structure of this analysis, the packaging, matches the rigor of the data.
Okay, so let's start there. With the presentation itself, the expertise is obviously there.
Absolutely. But, the analysis report's mixing of high-level financial assessment with overly presentation-focused language detracts from its intended rigor.
What do you mean by presentation-focused?
Well, it uses terms like the hook, video theme for the gambler. These are fine for, say, a different kind of media, but for a deep financial dive, they soften the tone.
Right. It almost feels like it's trying to be a marketing pitch instead of a serious assessment. And you're saying that risks undermining all the great technical work in the report.
Precisely. You want to project maximum professional gravity, especially when you're tackling a question like why a company with massive revenue growth is failing. So the suggestion is really to reframe the titles in the language, align the style with the expertise.
So give me some concrete examples. How do you make that shift without losing engagement?
It's a simple but powerful change. For example, instead of the hook, the impossible divergence, you rename it to something like executive summary, the core divergence and valuation paradox.
Okay, I see. The hook feels like a story, but executive summary immediately tells me this is a data-driven technical document.
It signals seriousness right from the first line. And it goes for the conclusion, too. We need to get rid of subjective labels like for the gambler or for the investor.
So what would you replace those with?
Something objective, like Scenario 1, high risk, high reward valuation profile, and Scenario 2, sustained profitability investment requirements. It transforms the piece from market commentary into a serious financial projection.
That makes perfect sense. The frame you put around the analysis is just as important as the analysis itself. Okay, so moving past style, let's get into the engine of the report, the structure.
Yeah, this brings us to the second major point. The current structural hierarchy minimizes the central explanatory power of the bear case section, and it really fails to use it as the definitive resolution to the whole paradox.
Right, the report is set up to answer that one question. Why the huge divergence?
Exactly. And the analysis correctly identifies the reasons for the 96% drop, dilution, delisting, liquidity, but it labels all of that as just the bear case.
Which positions it as sort of an alternative viewpoint, the bull case versus the bear case.
Yes, and that diminishes their true role. These aren't just counterpoints. They are the explanation. They are the critical systemic risks that explain why the market is totally ignoring that 18,000% revenue growth.
So the market has already decided. It's priced in these risks.
The market has already decided these risks are the story. They resolve the paradox you opened with. So the structure needs to reflect that cause and effect.
I can see why an analyst might do that, though. Maybe to avoid sounding too negative right off the bat, you lead with the good news, the revenue.
It's a common trap, but in a forensic analysis like this, logic has to dictate the structure. The suggestion here is to restructure the whole flow. You go directly from presenting the paradox to offering its structural explanation.
So you're saying elevate those risks, rename the sections, resequence them to hammer home that the market price is all about risk, not revenue.
That's it. So for concrete example, you'd rename that section. Instead of the bear case, why the 96% drop, which sounds a bit generic, you change it to something decisive, like resolving the paradox, systemic risks overwhelming fundamental growth.
That title alone tells you this is the answer. It's not just another opinion.
It is the answer. And even more critically, you have to reorder the risks within that section.
Right now, it lists dilution first, then liquidity, then the delisting threat.
And that's backwards. We need to move the NASDAQ delisting threat, that $1 minimum bid price requirement, to the very top. It's the foundational, quantifiable, frankly existential challenge.
That's a strong point. Why is that specific compliance rule so much more important that it should come before, say, the immediate fear of dilution?
Because it dictates everything else. It's an existential threat. If the company gets delisted, it moves to the OTC markets,
where liquidity completely dries up.
It evaporates, and their ability to raise the capital they desperately need becomes incredibly difficult and expensive. It's the ultimate ceiling on the company's valuation. By putting that delisting threat first, you clarify that this one regulatory issue is driving the whole risk profile.
So the analysis needs to state it clearly. The $1 minimum bid is the real reason the 18,000% growth doesn't matter. The other risks are just fallout from that central problem.
Precisely. And that leads us perfectly into the third area for improvement, which is really deepening the quantitative synthesis of all this.
The connection between their need for cash and the risk of dilution.
Yes, the report correctly flags the fear of dilution, and it points out that operating income was negative $2.3 million, even with that massive revenue jump.
Okay, the numbers are there. So you're saying the analysis should more explicitly synthesize the quantitative pressure from those high growth costs and the negative operating income?
It has to link it directly to the fear of dilution. That's the core weakness right now. The report states the $2.3 million loss, but it doesn't convey the urgency of that number.
I see.
The market isn't just speculating about dilution. That $2.3 million burn rate is the engine that makes future dilution a mere certainty.
It's the difference between saying they might need cash and showing the math that says, to survive, this level of dilution is almost inevitable.
Exactly. So the suggestion is to integrate the growth rate with the cost. Show that the 18,000% revenue growth comes with a $2.3 million operating loss. It creates a clear financial dilemma.
You have to quantify what it costs to maintain that growth.
Yes, and demonstrate why dilution isn't just a possibility, it's a high probability given their current expense structure.
So let's talk about the numbers. We've got this big negative operating income, but the report also says they have a positive net income of $97,000. How should the analysis use that contrast?
It should put them side by side. Introduce a focused calculation that shows that $2.3 million operating loss right next to the tiny $97,000 net income.
Okay.
That comparison makes it crystal clear that the core business is not generating cash, that positive net income has to be coming from non-operating sources, maybe a tax credit, an asset sale, some kind of one-off financial maneuver.
So the core business is actively hemorrhaging cash. The $97,000 is just hiding the real problem.
That's the exact takeaway. The market sees that operational burn rate and knows that this spectacular growth is completely unsustainable without a lot more outside funding.
And at a 4-cent stock price, that funding means massive, massive dilution. We need to make that calculation real for the reader.
We have to. The report has to quantify it. Given the huge trading volume, it should ask a simple question. How many new shares would the company have to issue just to cover that $2.3 million operating deficit?
So at 4 cents a share.
At 4 cents a share, covering that loss requires them to issue 57.5 million new shares.
Wow, that is the critical synthesis right there.
57.5 million. That would massively increase the share count and completely justifies the market's fear. That single calculation turns a monetary need into a tangible, painful dilution percentage.
And it makes the risk undeniable. It connects the dots between their operations, their growth costs, and the stock price collapse. It finally answers the question.
It's the powerful conclusion that synthesizes all the facts. It's what makes a report definitive.